in residential real estate, and this is different, but typically when you get a mortgage, there's like a LTV, loan to value ratio. Is there like a percentage in terms of you guys go in there and you'll assess it? Okay, this association can bill out so much, or they can assess so much. Therefore, we're going to go 50% loan to value. So let's say they need $1 million, you'll give them a loan for 500 grand, or what, maybe not you specifically, but generally, what is the common rule of thumb for a loan to value on one of these types of loans?
I mean, we look at the values of the properties, but remember, we're not lending against the property itself, right? So the value of the property does play into it.
Okay.
If the units are worth $100,000 and they're asking for $10 million, we've got to really see what the problem is. But we really don't run into that issue. What we really look at is we want the special assessment to not be greater than 75% of their normal maintenance fee. On occasion, we'll go up to 100, but 75 seems to be kind of the right number to be at. So what does that mean? If you're currently paying $500 a month in your normal monthly maintenance, we want to see the special assessment to be approximately no more than $400. So your new assessment is going to be $900 a month, right? But that's really where we gauge it at. And we have found over the years that number works with the owners and with the association. The real unknown here is when we start looking at the 2025 budgets that'll be coming out in November. We don't know what insurance is going to be. We don't know what they're going to need to do for reserves. So that unit that's paying $500 a month now, maybe that is going to be $900 a month just regular in 2025 because of insurance and reserves. So our concern as a lender at that point is, okay, if I layer on top of that a loan that now is going to take their assessment to $1,500 a month, well, that's triple what they were paying in 2024. And I think that's the part that as lenders and as community owners and as condos themselves or associations, that's the part that we have to kind of flush out over the first 3 to 6 months of the year to figure out, where that number is going to be. But from a parameter standpoint, we want to see delinquency less than 10%. We're probably the most aggressive in the industry right now. So those are really the two things that we look at that kind of stick out up front. I mean, obviously they have to have their financials in place and be in good order, and they have to get approved from our credit underwriting team. But that's what we look at. And I think that those are the things that are going to be sticking points in the first quarter of next year.
Okay. And let's just follow up with that. So the 75% basically, whatever the special assessment loan would be, let's say in this circumstance, it's got to be 75% roughly of what the previous maintenance fee was. Now going forward, do you guys actually mark to market it? Do you adjust it? So if there's an increase in maintenance of 20% the following year, are you simply going to is it going to be tethered and track with, so it stays in stuff?
No. It stays, we provide the associations fixed rate, fixed principal and interest loans.
Okay.
So, and primarily because of that, you can't give an association a variable rate because as rates go up, now you're just continually going back to the association, telling them, hey, your new payment is this or this. So they're fixed terms, fixed rates for the 5, 7, 10-year period of time.
Now,
no balloon, it's equally principal and interest amortized over the period.
Now, in terms of rates, can you give people an idea in terms of how it comes in? And let's again apply it to like residential real estate, because some of our audience members, they primarily deal with mortgages rather than anything else. It's based off 10-year treasury plus a typical mortgage, generally speaking, whatever the 10-year treasury is for the audience. You're going to add about 3 points in general to get an idea what your mortgage should be. Is there any kind of way that the audience can understand, like what kind of interest rate one of these special assessment loans might come in at ballpark?
Yeah, these are commercial loans, right? So it's not a personal loan. So it's a commercial loan, but we do it the same way. We tie it to the treasury. So if it's a 5-year or 7-year or 10-year, we tie it to the treasury, and the spread is anywhere between, 295 and up. Right? 295, 300. So it's pretty, because we want them to understand where the rate's coming from and it's an aggressive rate, if you will, for the market that it is and for the period of time. And then there's no surprises, right? It's not like we're pulling that number out of the air. They know what it is. We close it, we fix it the day of closing, and it is what it is.